Now, there's a saying go that you might be familiar, and that is, in life you can't avoid two things: death and taxes. But what if I told you there was a way to pay zero taxes, or at least close to it, using legal, ethical, and moral strategies that even the IRS publishes it on their website? And we all know that these wealthy senators and congressmen, they're the ones that are writing the rules for themselves. So wouldn't it be helpful that we understood what those rules are? And I ultimately see finance and making money and growing your wealth as a one giant game. And for you to win that game, you need to know the rules. So the following video I'm going to show you is actually a recording of a masterclass that I did for my own clients in helping them save money on taxes. And I'm going to show it to you guys because I really love you and I really don't like the IRS. You know, I think most people don't. So first thing first is we're going to talk about how you're getting taxed. You need to understand the basics as to what you're being taxed on and what number you're getting taxed on in the first place. Now, in my opinion, I believe that there are two different types of taxpayers in the US economy, and they pay taxes a little bit differently. One actually is paying less and the other is not. The first one being is W-2 employee. Now, I believe the W-2 employee is in the category of those that pay the most amount of taxes, and here's why. As a W-2 employee, let's say you make $100,000 gross income. And when you make that $100,000, does all $100,000 go straight into your bank account? No, right? You typically see your pay stub, which says FICA, Medicare, federal tax. If you pay state taxes, you'll also see that line being deducted. So we know that not all $100,000 of your gross income is deposited into your bank account right away. Before you even see it in your bank account, you already see $20,000 or so deducted, depending on your tax situation. And you see a net of $80,000 that you actually see in your bank account. Now, at the end of each year, what do? You do your tax returns. Now, one quick note about the tax being deducted from your gross income is that this is what your employer pays on your behalf, letting the IRS know, hey, I'm paying this employee $100,000 a year, and we're anticipating that they're gonna pay this much of taxes, so they're taking that money out in advance before you see it on your bank account. But realistically, what happens? Now, every January and February, what do? Well, you file taxes. And when you file taxes, what you're doing is you're telling the IRS, wait a minute, I paid this $20,000, but I really shouldn't have, and here's why. This gross income is actually considered taxable income. And how do we reduce taxable income? Well, there are certain deductions that we can make. There's something called standard deduction, which I believe for 2024 is about $14,300. Or you can opt in to take what's called line item deduction. Now, what are some of those deductions? Say them out loud, right? There are, let's see, itemized deductions. In that list, there are things like mortgage interest. There are also certain student loan interest as well. You can also deduct property taxes to a certain extent, 401k, IRA, HSA, which by the way, I believe to be is a very underutilized tool that I think most people aren't taking. We'll have a separate video about that for you pretty soon. But 401k, IRA, HSA, I generally classify them into one category as qualified contribution to a qualified retirement plan. There's other things like charity, right? Childcare expenses can also be deducted. Okay, childcare expenses. So if you have many kids and you send them to school or you pay for tuition on certain childcare, yes, it could be deducted as well when it comes to your taxes. So when we sum all this up, let's just say when we combine the amounts of your mortgage interest that you're deducting, student loan interest, property taxes, your 401k, IRA, or HSA contribution, charity, childcare expenses, let's just say by adding all this up, we have a total sum of $20,000 that we're able to deduct. Now, what that $20,000 does, it reduces our $100,000 of taxable income to now further down to $80,000. So guess what? We already paid the IRS $20,000. That's already been deducted withheld by your employer. Guess what happens? In this scenario, you overpaid taxes, and this is why most W-2 employees will get a tax refund. It's basically the IRS say, hey, you overpaid based on what you're telling us, and these are qualified deductions that you're able to write off and reduce your taxable income. Therefore, we're going to send you money back, taxes that you shouldn't have paid us. So that's how you get tax refunds. Now, I believe this category, the W-2 employee, represents the majority of people out there, and I believe people pay too many taxes. Now, can you write off things like your cell phone? Can you write off internet? Can you write off utility costs? Can you write off your auto expenses? Not as a W-2 employee, you cannot. But the moment you enter into the second category of people, or you have most kinds of business income, as soon as you start to introduce a 1099, contractor income, business income, or you own a business, things look radically different. Okay, you know I mentioned that you could write off cell phone, internet, auto. These are some of the things that you can do as a 1099, contractor, business, if you have business income. Literally, the moment you introduce some kind of business income, for the most part, things look radically different. So let's go and use that $100,000 gross income example again, just to give a very fair income. And this is $100,000 gross income generated as a business income or 1099 contractor income. Maybe you have a bookkeeping income on the side, maybe you drive for Uber, maybe you have a lemonade stand. And in a moment, I'm gonna share my personal favorite, and I believe this to be the best business and investment opportunity that you can get into that could potentially reduce your taxes down to zero. So stick around, I'm gonna share what that looks like. Now, as a business owner, you can still write off mortgage interest, okay? Mortgage interest. You can write off student loan interest, right? Just like a W-2 category, mortgage interest, student loan interest, child care expenses, all the standard personal itemized deductions you can take as a business owner, okay? With some exceptions. But as a business owner, we could do something called, what I like to call, personal to business expense conversion. The moment you become a business owner, right? If you use your cell phone to further your business, that could be considered a business tax write-off. So in that category, you have your phone / internet. If you use your phone and internet to further your business and use it towards creating business income, yes, you can write it off. Now, the IRS defines business expense as any expense that was incurred and justifiable in generating business revenue. So in the case of a phone, if I use my phone to send emails or call my clients, to call customers, to call sellers, whatever the case might be, then did I use my phone to further my business? The answer is yes, and therefore I can write off all, if not parts, of my phone and internet bill to justify that it was business expense. Even if we were to go back to our W-2 category, you were gonna use your internet and phone anyways, so might as well convert it into business expense. Another one is auto. Okay, auto or car expense. So auto, you can deduct mileage. So for every mile you drive, you can deduct a certain amount from your income, or actual expenses, so oil change, gas, and so on. As long as you use your car or traveled because of a business related event or inquiry, then yes, you can write off auto and car. Same thing with travel. Okay, travel. So one thing I like to do with travel is that anytime I go to Disneyland or Disney World with my family, I always try to figure out how do I convert this into a business expense. In fact, what I did to write off my trip to Disney World is I went and set up a business meeting, a client meeting, literally the day before my Disney World trip, and I set up another client meeting after my Disney World trip. So I'm in Florida the entire time, meeting clients, then going to Disney World and meeting with another client. So what I was able to do is I was able to write off my travel expenses related to that Disney World trip because I was there for business, meeting clients, and furthering my business. So therefore, I converted much of my personal travel expenses into business expense. Does that make sense? I mean, I had to go to Disney World anyways, might as well make it into a business expense and a write-off to further reduce my taxable income. The other common ones, right? Electronics. Some good examples are laptop, tablets, smartwatches as well. That could be classified as a business expense. Laptop, obviously I have to use a computer to access emails and business inquiries and so on. So I can write off electronics and equipment in that category as well. The other one is home office. Home office. So if you have an office space at home, to me, I have a portion of my basement carved out for my home office. I can take that square footage and write off expenses that are associated to it. So water bill, electric bill, internet bill, my personal internet bill. Portion of it can be written off as a business expense because I've used my home office to further my business, generating revenue. Does that make sense? The other one is paying family members. Paying family members. And I'll get to this in one sec. There's a whole section for that, especially for paying kids, and there's a whole different strategy for paying spouse, which we'll get into. But paying family members is a great tax deduction, which I'll break it down to you in just one sec. Another one I'm gonna throw in here is dining. Okay, dining and certain meals. Now, good example is when my brother and I go out and eat and we talk business, is that a personal meal? No, it's a business meal because my brother and I are chatting about our next real estate deal. We're talking about our business, how we can do it better, and conversations that we generally have are in business in nature. So as of 2024, I can write off half of the business meal expense against my gross income. I mean, I was gonna eat anyways, right? So you notice something here is that as a W-2 employee, if you only have W-2 income and that's all you have, there we go, okay? These are the expenses that were paid after the fact that you paid taxes, right? Whereas on this category of the 1099 contractors and business income, much of the personal expenses that they were gonna pay anyways were converted to business expense and further reduce the gross income. So as a W-2 employee, and we talked about how the combination of your itemized personal deductions were about $20,000. So we'll go and apply that here as well. So and change to red. Okay, so let's just say that's $20,000 that you were able to deduct for itemized personal deductions, but we also have business expenses that were related to generating that $100,000 of gross business income. Let's just establish that this amount is, let's say $40,000, okay? Very reasonable, because if you have home office, if you have paying family members, and which I'll get into in a sec, dining, electronics, travel, auto, right? All these things can rack up very quickly to $40,000 amount. Well, the other thing I missed out is something called the Augusta rule, which you can talk to your CPA about, but the basic premise is that if you used your personal residence to host a business meeting, a business conference, or maybe a seminar, you could pay yourself a fair market value or fair market price to rent a conference room or to rent out a business space. So let's say in this area, in my immediate area, it would cost me $300 a day to rent out a conference space at a hotel. Well, I can pay a similar amount to myself for hosting a business function, a business event at my personal residence, and it's tax-free. So next time I have a business party or business function, business seminar, business class, I can host it at my home, pay myself the amount that I would have paid a hotel or some kind of event space vendor, and make it tax-free, which is amazing. That's even more of a tax deduction on top of this. I mean, there's so many different creative ways to justify for a business expense, and I'm just scratching the surface, and this is the tip of the iceberg. So definitely ask your CPA, your tax professional. They're gonna have additional ideas for your situation if you're in this category to further reduce your taxable income. So what this does, 20, 60, right? Now, instead of a $400,000 taxable income, we're down to just $40,000 in taxable income. Completely different bracket, and you're paying a significantly less taxes as opposed to paying the $400,000 or even after the personal deductions, which as a W-2 employee, right, you would have been at $80,000 taxable income even after some of the personal deductions you've made. But as a business owner, you've converted a lot of the personal expenses into business expense, and therefore your taxable income is significantly less. Does that make sense? Now, before we get into what I consider to be the best investment business you can get into that will further lower the tax liability, let's go and talk about paying family members. This is something that I see the wealthy do really, really well, and quite honestly, this is something that I do as well. So paying family members, okay? How many of you guys have kids, grandkids, right? If you have kids and grandkids, you guys all know it's pretty expensive, right, to have kids. Pay for diapers, food, soccer practice, prom dresses, you name it. I mean, kids are expensive, but we love them. But kids are expensive, all right? I still love them, all right? Don't worry. But we all have to admit, right, every time we go to Costco or Sam's Club, man, the grocery bills rack up. What if we can turn much of that expense, paying kids, into business expense? Now, if you're in that category of the 1099 business owners and you own a business, here's what you can do, okay? If you have kids, your kids can perform some kind of a service or render some kind of value exchange, and you can pay them, and if they're under the age of 18, you can pay them to up to the standard deduction amount, which I believe is about $14,000, tax-free. In fact, I'll give you a personal example of mine, okay? So I have a daughter, and she's amazing. She's 4 years old. She's very adorable, very cute. You may have seen her on a YouTube video, and that's because there's a reason for that. Now, when she was 3 years old, there's really not much you can do, right, as a 3-year-old, but she is adorable and she's very beautiful. So here's what I did. I actually had her show up to a YouTube video, make an appearance on my YouTube video, and because she's very beautiful and adorable, she charged me a $6,000 per video appearance fee, and we paid it. And here's how we did it, okay? So my business is here. That's my business. Paid, at least at the time, my family management company, which is a separate company, it's a sole proprietorship, and my family management company paid my daughter physically into her actual checking account that money. So that $6,000 was transferred to the family management company. There was an invoice, receipt, contract, whole 9 yards, very well documented, scanned and saved. And that family management company also had a contract with my daughter, which my wife signed for, and paid my daughter $6,000. Now, because my daughter is under the age of 18, she does not have to file taxes. And if I were paying her this year in 2024, I can pay her up to around $14,000 tax-free. And guess what? Now that she's got $6,000 in her checking account, guess what? Next time we go to the toy store, I ain't paying for the toy. My daughter is out of her checking account, right? She needs medicine. Hey, she's paying it out of her checking account. She needs to go to a ballet or gymnastic lesson. I'm not paying for it. My daughter is paying for it out of her checking account. See what we did there? So the way that we justify this to be a business expense is that $6,000 isn't a legitimate appearance fee, like a loyalty that you pay to an artist or a model, right? $6,000 per video, and I had to have her in there because the video that I was making needed a 3-year-old Asian girl, right? That's what was needed. And $6,000 I paid her as an outside service that went to my daughter, and my daughter is now paying for lessons, food. Even better, guess what? Now we can start doing investments. My daughter is now funding her own 401k IRA, life insurance, whole 9 yards, tax-free. So I was able to reduce my taxable income, my business taxable income, further by $6,000. But again, these were the things that I was gonna pay anyways. As a W-2 employee, right? Let's go back to my W-2 employee example here. You are paying for those expenses after the fact that you paid the taxes. So you've already given the IRS their money, and then you're paying this after the fact. Well, now I was able to take the expenses that I would have paid out of my personal pocket and convert it into a business expense indirectly, and it's totally justifiable. Now, this isn't the only example. I have friends who have a little bit of older kids, and these older kids are cleaning their daddy's or their mommy's office for a reasonable compensation for a cleanup. I have also friends that have a professional paper shredder at home and shred the paper for their home office, and they get paid a certain amount, tax deduction. I've also seen examples for teenagers where they're great at video editing, Photoshop, right? Mom and dad doesn't know how to do that, but these 13 and 14-year-olds do. So well, guess what? Mom and dad, who owns a business, is paying their 13 and 14-year-olds to edit videos and do photography, do video editing, and mom and dad is paying them up to $14,000, assuming 2024, $14,000 per year, and those kids don't have to pay taxes. And mom and dad could write off $14,000 as outside service, and therefore decreases mommy and daddy's taxable income and saves them a ton of money. If that $14,000, if the individual is getting taxed at 20%, that is nearly $2,800 of taxes saved that year per child, which is amazing. So if you're paying allowance, if you're giving your kids free money, stop it. The moment you introduce business income and you become a business owner in your finances, this will open up to you. In fact, what I love about the IRS tax code is, and this is figuratively speaking, about the first 10% of the IRS code is all about how they're gonna tax you. Okay, here's the tax rates, here's the tax code, this is what you pay, boom. The remaining 90%, figuratively speaking, are exceptions to that 10% rule. So the IRS says, hey, this is what you pay. The rest of the 90% of the tax code are, hey, here are the exceptions. If you fit this category, you don't pay this. If you fit this category with your income, you don't pay this tax. Or if you are in this category, you get a tax discount, right? There's exceptions to the rule. So wouldn't it be nice, or at least helpful, for us to know some of those exceptions that will apply to us so that we can pay less taxes, right? So with that being said, this, my friends, is how the wealthy stay wealthy. This is how the wealthy is able to save money, take that money and contribute to their retirement, to their investment, accelerate their growth. This is how they're doing it. So here you go. This is a massive, massive tax deduction, especially if you have kids. Grandkids also apply. If you have mom and dad, that works for you. I'll give you another personal example. My parents, they're also a part owner of our real estate portfolio. And they moved back to South Korea about 10 years ago. So every time I visit my mom and dad, guess what? Is it a personal trip? No, we're doing a board of directors meeting with my parents to discuss our real estate portfolio. Right? So guys, think creatively on how to incorporate your family into your business and how to keep the money within the family. Stop giving money away. Now, we talked about how as a 1099 contractor or a business owner, or you have business income, we were able to further reduce our taxable income to $40,000. But can we get lower? Can we go to zero? Yes, we can. Okay, let me give you the next part of it. And this is where I'm gonna talk about my favorite investment in business to get into, and that is very simple. It's rental real estate. Rental real estate, I believe, my opinion, in fact, you can ask your CPA, your tax professional, they'll probably agree, rental real estate by far, in my opinion, is the best tax-saving investment in business you can get into. And here's why. Not only do you have all the typical business expense like travel, right? You may also have interest costs, if you have financing, property management expense, which really is within the outside service category. Okay, you'll have all these typical write-offs like phone, utilities, right? Internet, pretty typical. Now, what is unlocked to you additionally on top of these pretty typical business write-offs that we just talked about? Of course, you get your rental income, you get real estate appreciation, your real estate value goes up every year. You also get this very amazing thing that the IRS gives you called depreciation. Okay, in fact, I'm actually gonna make a whole separate section for this, for depreciation. There we go, depreciation. Now, depreciation, I know most people who hear that term go, oh, that means your property value goes down, right? No, in the accounting world, depreciation means something entirely different. The IRS knows that when you buy a piece of property, okay, you bought a single family house or a multifamily apartment, whatever the case might be, the IRS knows that this piece of real estate won't stay in the same condition for the rest of its life, right? It's gonna go through wear and tear, the paint wears off, the carpet gets moldy, right? The roof kind of settles, the foundation gets settled, right? The condition of the real estate will deteriorate over time. So the IRS understands that, and it gives the rental real estate owner the ability to expense part of the purchase price of the real estate. Now, one key note, and your tax accountant will tell you this, is that you cannot expense or depreciate land. You can only depreciate the building itself, the actual structure. So not the land, the structure. So let's just say you bought a piece of property for $275,000. This is a 3-unit multifamily rental property. You know it's gonna be very profitable. You've done the analysis, the numbers work. 3-unit apartment, $275,000. And let's also assume that the entire $275,000 is the value of the building, just to keep it simple for this masterclass. Now, what you're able to do in depreciation, because this is a residential property, we can depreciate this for 27.5 years. What that means is we're gonna take the building value of the property, divide it by 27.5, which is $10,000, that we can expense every single year for the next 27.5 years. Does that make sense? If this was a commercial property, it would be 39 years. So if you bought a warehouse or a self-storage unit, an office building, you would depreciate it using a 39-year depreciation schedule. Now, this $10,000 is a depreciation, like a business expense, that we can add as business expense, and it further reduces our taxable income by $10,000. Now, the question is, did we lose that $10,000 from a bank account? No. This is a loss just on paper. We still have that $10,000 in our bank account. We didn't physically lose it. This $10,000 is IRS allowing us to expense and take portion of the value of the building and write it off, knowing that we're gonna have to do upgrades and capital improvements and remodeling in the future to maintain the condition of the property. Does that make sense? So that $10,000 is further reduced. Again, if we're using this example here, or let me just pull it up, $40,000. If we had a $40,000 taxable income and we subtract the depreciation against it, that means our taxable income comes down to just $30,000. And yeah, I know there's rental income that we need to account for, business expense, and so on. But to keep it simple, to illustrate my point, depreciation will further reduce taxable income and therefore saving you money. Let's just say that you're in a 25% tax bracket rate. That means you just saved $2,500 on taxes just by getting into rental real estate. Plus you get appreciation for long-term capital gains, and you have rental income coming in, which for many of our clients, the goal is to buy more rental real estate, generate income that will either supplement their retirement or to completely replace their job income so that they no longer have to rely on their job income to continue to provide for them, financially speaking. Now, that's depreciation. But can we do better? Yes, we can. There's another version of depreciation that is called cost segregation. Now, what cost segregation is, instead of looking at this entire building value and just doing a 27.5 years of depreciation, what we're doing is we're taking a piece of real estate and taking it apart and looking at each piece of the real estate as its own depreciable items. Here's what I mean. So here's a window, here's a roof, here's a door, the property's got electrical system, plumbing system. The different components of this real estate can be broken apart to be depreciated individually instead of the whole entire building. So the depreciation schedule actually is much quicker. It's typically 5, 7, or 15 years. So here's what that means as an example. Again, I'm not precise on this, but you can ask your tax professional. To do cost segregation, your tax professional is going to do something called a cost segregation study. They'll go and take a look at the property, break it apart, analyze it, assign values to each of the different components. So they might say, hey, this roof looks like it's gonna be about, it's gonna be $50,000 of value. The windows, all the windows are about $10,000. Your plumbing is, let's say $15,000. Your electrical system is $20,000. This porch you got here, $10,000. So they'll break apart the building literally into pieces like Lego and go, hey, each of these parts have individual value and they have individual depreciation schedule, which is shorter than 27.5 years. Well, why is that important? Well, if we can depreciate, let's say the windows or the electric system in 5 years, which is $4,000 a year. Let's say we could depreciate your plumbing system in 10 years. That's $1,500. Yeah, $1,500, there we go, $1,500. Let me scratch that off, there we go. $1,500 a year, $4,000 a year. Your roof, let's just say 5 years, so that's $10,000 a year. Again, not exact. Ask your CPA, tax professional, about the exact numbers of these. I'm just giving you an example. So the windows, let's just say 5 years. So that is $2,000 a year. And your porch, let's say, is 5 years too. So that's also $2,000 a year that you can depreciate. So now combining 4,000, 15,000, it's 19, right? 29, 31,000, 33,000. Now being able to depreciate $33,000 as opposed to 10,000, guess what? We have now brought this, let me use a different color, $33,000. Now we brought this down to nearly $7,000 of taxable income. Pretty good, right? We just saved, again, if you're at a 20% tax bracket, let's just say on a $33,000, you just saved nearly $6,600 on taxes. Pretty good. I mean, that's awesome. We can take that $6,600 and then be more aggressive with our investment, to retirement, save money in general, afford things, right? So many possibilities just because we've bought a piece of property. The wealthy know that by getting into real estate, they can save money on taxes on their earned income, right? Through cost segregation, depreciation. There's also bonus depreciation, which we're not gonna get into today, but there's so many avenues of saving money on taxes through real estate. At the same time, get the benefits of appreciation, you got rental income coming in, long-term capital gains. There are various benefits of investing into rental real estate just outside of generating passive income and appreciation and so forth. This is powerful. I ultimately see finance and making money as a game, and it's really important for you to know what the rules of the games are so that you can win. Can you win a game if you don't know the rules? No, right? Just imagine playing football with a group of friends, right? And not knowing the rules, can you win? Probably not, right? But the moment you know the rules and understand why the rules are made the way they are, and you know how to play them right, then yes, your chance or your odds of winning are gonna be significantly higher. And it is so true when it comes to your financial well-being and being successful with money. Now, I know what you're saying, Sam, but buying a rental property comes with all the headaches, the tenants, the toilets, the termites. I have to worry about all this. You know, where can I buy real estate? I'm in California, I'm in New York, prices are crazy. Well, buying a rental property can be a headache if you don't know what you're doing. Okay, in most cases with my clients and even for myself, I've set property management on autopilot with a process and a system. This is why I don't have to get up at 2 a.m. to deal with a property management trouble. If you have the right system, the right process, and the right people in your team, then yes, property management will take care of its own. It'll be self-managing, and you don't have to get up at 2 a.m. to deal with a tenant trouble. I mean, I'm pretty much at a point where rarely I'll hear from my property managers. They'll send me a report and send me a check, and that's really it. It can get that simple. But for most people who are getting into rental real estate, they're not educated, they don't have a system, they don't have a process, they don't have a team. This is why you'll hear horror stories of landlords that make poor decisions that lead to headaches, and then ultimately them telling you not to get into it because they had a poor experience. I'm here to tell you guys that you don't have to have the same experience, the same poor experience that a lot of these amateur real estate investors have. You could very much have a portfolio that is self-managing, on autopilot, with the process, that will give you more freedom of time, freedom of money, and flexibility, unlike the amateur landlords and real estate investors. So guys, I hope this masterclass gave you some ideas and context information that you can ultimately go back to your tax professionals about, talk to them about how to get into real estate. How do I get into some of these tax saving strategies? How do I introduce business income in my life? Talk to your tax professionals. It's so important because everyone's finances are a little bit different. Now, if you want to get into real estate, like how I explained in this whiteboard, go and check out some of the other videos that we have on our YouTube channel where we show you step by step on how to get into real estate investing, whether you want to go into single family, apartments. We're going to show you the A to Z of buying rental properties, cash flowing successfully, and building a system so that you don't have to have the headaches of bad property management. So with that said, we'll see you in the next video.